Imagine waking up one morning to find your entire financial world completely shattered. This is the story of the Great Depression. During the 1920s, the United States experienced rapid economic growth. Millions of Americans were purchasing their first automobiles and household appliances, while industries like construction and electricity expanded at a breakneck pace. But beneath the surface, the foundations were uneven. Significant income inequality meant that while some grew wealthy, many others saw that wages stagnate. Farmers were already struggling with falling prices, and factories were quietly producing more goods than consumers had the money to buy. At the same time, the stock market became a popular obsession, driven by a practice called buying on margin. Investors would put down a small amount of their own cash to buy a stock and rely on borrowed bank money to cover the rest. Much of the decade's prosperity relied on this high level of debt. If stock prices stopped rising, those loans would immediately come due, trapping the American economy in a mathematical corner where one small decline could trigger a total collapse. In October 1929, the growth stopped. The stock market began to falter, and the optimism of the decade evaporated into a rush of panic selling. Millions of shares were traded as investors tried to get out of the market before their remaining value disappeared. The decline accelerated on October 29th, known as Black Tuesday. On this single day, billions of dollars in paper wealth vanished, leaving thousands of investors in financial ruin. The stock market crash was not the sole cause of the economic crisis. Instead, it acted as a trigger, exposing the underlying weaknesses of a system already strained by debt and overproduction. The crash destroyed the nation's sense of security. The belief in an ever-growing economy was gone, replaced by a sudden loss of trust that would quickly spread from Wall Street into the banks, where ordinary Americans kept their savings. At the time, the United States had no federal deposit insurance. Terrified that their banks would run out of cash, citizens rushed to withdraw their life savings, creating massive, uncontrollable bank runs. This created a lethal chain reaction. Thousands of banks failed, halting loans to businesses, which forced factories to stop production. Shut down, they let their workers go. By 1933, roughly 1/4 of the entire American workforce was unemployed. Millions of families struggled to pay rent or buy groceries. In cities across the country, out-of-work citizens stood in long lines for food, relying on charitable organizations just to survive. Because there were no federal financial firewalls to contain the damage, the panic on Wall Street successfully mutated into a nationwide humanitarian crisis that affected both cities and rural communities. The economic collapse was compounded by an environmental disaster in the Great Plains. Years of severe drought, combined with poor farming practices, stripped the topsoil and created massive, suffocating dust storms. The region became known as the Dust Bowl. With their crops ruined, thousands of farming families were forced to abandon their land and migrate west toward California in search of work. As the crisis deepened, President Herbert Hoover maintained that the government should rely on voluntary cooperation between businesses and citizens. He was reluctant to use direct federal power to intervene in the economy. This limited response could not keep up with the rising poverty. As people lost their homes, sprawling shantytowns of makeshift shacks appeared in several major cities. Out of frustration, the public named them Hoovervilles. As breadlines grew and the Hoovervilles expanded, the administration's reliance on private charity failed to meet the scale of the disaster. By 1932, the public's expectation for help had surpassed the government's willingness to provide it, creating a demand for a completely different approach to leadership. Franklin D. Roosevelt won the 1932 presidential election by a large margin. His victory was fueled by a public that was desperate for the federal government to take a more active role in the crisis. When Roosevelt took office, he immediately declared a temporary nationwide bank holiday. This stopped the bank runs and allowed the government to examine banks before they were permitted to reopen, slowly restoring the public's trust in the system. He then introduced a series of programs known as the New Deal. This legislative blitz had 3 specific goals: providing immediate relief for the suffering, helping the economy recover, and reforming the financial system to prevent another collapse. The government directly created jobs for millions. Programs like the Civilian Conservation Corps and the Works Progress Administration employed out-of-work Americans to build roads, bridges, parks, and schools across the country. By providing direct employment and ensuring personal savings, the government moved from a distant regulator to a direct provider. For the first time, Americans looked to the federal government for their income and the protection of their future. These policies were not supported by everyone. Many conservatives and business leaders opposed the expansion of federal power, and despite the programs, the economy suffered another significant downturn in 1937. The definitive end of the crisis only arrived in 1941, when the United States entered World War II. It required total industrial mobilization on a scale the world had never seen. Factories expanded to produce aircraft, ships, and weapons. Between the millions entering military service and the millions more hire for wartime production, the massive unemployment of the 1930s finally disappeared. The New Deal had stabilized the banks and provided relief to the suffering, but it ultimately required the massive demand of global war to fully restart the American economy. The 1930s crisis forced the government to build new walls around the financial system. Regulations were passed to separate commercial banks from the stock market, creating the oversight structures that still monitor the economy today. The most enduring institution from this era is the Social Security Act of 1935. It established a federal system of retirement benefits and assistance, ensuring a permanent safety net for the country's most vulnerable citizens. The Great Depression began with numbers on a financial screen, but its devastating human lessons still matter to us today. Today, modern financial firewalls and strict banking regulations stand in the way of a similar collapse. These protections exist entirely because of the devastating lessons learned from this exact era.